episode 136, Taking Real Estate Losses as a Limited Partner with Real Estate Professional Status. This is a 39.6 Facebook and YouTube Live Finance Show. A show that teaches high earners like yourselves how to make your money work for you, so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. Today's question from Vincent in the Facebook group, 39.6 community. Please invite a friend if you haven't. Help us get to 1,000 members. His question is, if I file as a real estate professional, can I use the K-1 losses from an LP in syndications to offset my W-2 income? What if I were a general partner instead of a limited partner? I've been asking around and have received conflicting answers. I thought that as a real estate professional, all of your passive real estate income / losses become active, including losses from syndications. But I recently heard that may not be true. Thank you for your help. Okay, so this is going way into the weeds, but it's a very, very important question, and goes really into the legal technicalities, the tax technicalities. And I am not an accountant. Okay. I say that like 10,000 times in this presentation. I'm not an accountant, but yes, this is complicated because it puts together multiple different rules, like an exception to an exception. It's kind of like what's the square root of -1, right? It's like imaginary. I don't know how I think about these things, but but I squared is -1, right? So like I is like this imaginary number, which is basically, I say this because it defines like an exception to a rule. So you have to create something that makes probably no sense to a lot of people, but regardless. So first of all, real estate professional status, we've talked about it a number of times, but assuming you have real estate professional status, okay? And first you have to qualify for that, but just as a refresher, okay? And I have this on the second page. This is from the realestatecpa.com. But you have to first qualify as a real estate professional, you need to have more than half of your personal services performed in trades or businesses of the taxpayer during the tax year performed in real property trades or businesses in which the taxpayer materially participates. Okay, this has to also equal 750 hours at minimum of this individual. Okay, this is not jointly with your spouse. This is of an individual. Okay, has to be in real estate, real property trades or businesses in which the taxpayer materially participates. Now, so those 750 hours also have to make up more than 50% of your work. So that's the majority of what you do. So that's real estate professional status, but that is only one criteria that opens up the door, okay? When you're doing your tax return, if you're doing TurboTax and you have a rental property, it'll ask you if you materially participate in your rental, okay? So back when I earned less than $150,000 jointly and I self-managed my property, well, I actually qualified as materially participating in that rental, and I was able to utilize the depreciation from that rental property to offset my income because I was below the $150,000 passive activity loss limitation. Okay, so that was like no big deal. You did not need to have real estate professional status. But to get past that $150,000 barrier, you have to then basically get to real estate professional status for passive rentals. Okay, so then you have to get those high numbers, the 750 hour rule, more than 50% rule. That is just to potentially get above the $150,000 limit, but you still have to qualify and have material participation. Okay, so if you have less than $150,000, you could have 20 real estate properties, rental properties. If you don't have any material participation in any of them, and you don't qualify for real estate professional status, it doesn't matter. You can't actually use those losses readily to just offset your income because you do have to have material participation. Okay, so material participation is an additional criterion in addition to having the real estate professional status. That is assuming you are earning over $150,000 per year. If it's under $150,000, it doesn't really matter because you can still take a $25,000 loss. If you want to take a loss more than $25,000, regardless of your income, you have to have a real estate professional status. Okay, so then you have the question of what is material participation. Okay, now there's 7 rules here. The first one is an individual participates in the activity for more than 500 hours during the year. And I think this actually could be you or the spouse for this material participation portion. The professional status has to be one person, and the material participation has to also be met, but it doesn't necessarily have to be the same person, from my understanding. That could be wrong, though. Please correct me, somebody, if I am. Now, that is one of them. There's a whole bunch of other ones. Okay, individual participation in the activity for the tax year constitutes substantially all of the participation in such activity of all of the individuals for the year. Okay, so like if you're self-managing it, then yeah, even if you technically have a property manager, I mean, depending on how much management requires, and there's management at the property level and then also at the asset level, different things, you could potentially still qualify. Depending, like if you have no turnover and no repairs, and the property manager might not really do much over the course of any individual 1 year. Okay, now rule number 5 here, the individual materially participated in the activity for any 5 years. They don't have to be consecutive during the 10 tax years immediately preceding the tax year. Okay, so it could have been like, I've had my rental property, let's say for 6 years now, my first one. And for the first 5 years, I materially participated. Now, like for the next 5 years, I will qualify as having materially participated in that property, even if I don't participate in it in the current year, because I basically grandfathered myself in for the next 5 years. Okay. Next one, or activity is a personal service activity, and the individual materially participated in the activity for any 3 tax years preceding the tax year. Okay, so but there's a number of them, and we haven't even gotten to the point of this. But if you qualify for material participation in an asset, and as a limited partner, according to this, you would have to qualify based on 500 hours during the tax year, or 5 of the first 10, or this other 3 rule number 1, 5, or 6. I've also, so that's as a limited partner. So those are actually very challenging to meet as a limited partner. So the easy answer is no, you don't really qualify because you have to materially participate in the property. Okay. And look at each individual property, and the simple, straightforward way to do your tax filing is for each property, did you meet the material participation test? Okay. And as you can imagine, the more properties you have, it can actually become harder and harder to meet them because you're scaling, which means as you scale, you spend less and less time on the asset because you are outsourcing more and more to it. So you're not going to hit 500 hours, okay? You might not hit any of them, okay, individually. It can become very difficult the more assets you have. So interestingly enough, you could have like millions and millions of dollars of real estate assets, and you could spend all of your time doing all real estate activities, even all real estate rental activities. Okay. Although technically they say like investor hours, like searching for properties, doesn't necessarily really count as hours for, doesn't count for material participation because you're not participating in that actual asset. So you could put in all these hours and not qualify for material participation on like any of your assets, even though you're spending, let's say, 2,000 hours a year in real estate and doing nothing else. Okay, and that doesn't seem right? Like if all you do is real estate and all you do is manage this gigantic portfolio at the asset level. And what I mean by at the asset level is you're not managing it at the property level. Like you're not doing the day-to-day, you're managing the property managers, okay? And you're basically hands-off from the asset itself. So then how can you qualify? Okay, so there is this other clause. Okay, so this is like the exception to the exception. So real estate professional status is like the exception, and then there's this additional exception called the real estate grouping election. Okay, this is okay. So all of this stuff comes from section 469 in the tax code. It's like super huge. I haven't read it. But this this is coming from the Journal of Accountancy, which is like a very high level journal. I think I've cited this before. But 141, okay, regulations, section 1.469-9G, grouping election, allowing a qualifying taxpayer to treat all rental real estate activities as a single activity. Okay, so assuming you already meet real estate professional status, then you could say, I'm going to take, let's say you own 10 single family properties. You could say, I'm going to take all of them, combine them. I'm going to make an election in this current year, 2020, that these 10 properties, I'm going to aggregate them as a single group and consider them like one big property. Like think of it as like one apartment complex, okay, or one portfolio per se. Okay, so now you just have to meet material participation for your portfolio. This is a lot easier than meeting it for each individual property. Okay, so 10 properties, aggregate them, boom. Let's say I bought them all this year, bought 10. It's very simple, very clean. Okay, I could buy it. Let's say I bought a portfolio from somebody else. All 10 properties, all in 1 year, done. They're all grouped. Okay, very simple and straightforward. And I could even take the property management team that the person had already and just keep them along with it. We just sold it owner to owner and boom, everything is plug and play. Okay, now let's pretend I decided to also invest in a syndication right before the year closes. So I do that investment in the syndication and I'm a limited partner in that deal. I wanted to get a little bit more real estate losses and I had an extra $100,000. So I chunked it as a syndication that closes before December 31st. So I can get one more K1 with a nice negative number because they take bonus depreciation on it. And I get this negative $70,000. Well, I could choose to aggregate that limited partner election along with my other real estate investments, okay, and have them all be in one big group. So once that limited partner investment gets connected and grouped with other activities, then it is all considered one aggregate, okay? So that is basically how it works. You could invest in like 10 limited partner deals and boom, put them all together. But again, remember, it's still hard to meet those material participation tests as a limited partner only. You probably want to have some other thing. Like, let's pretend you're a general partner on one asset. Okay. And then you have a bunch of other LP deals as well. Or you have your own single family rental portfolio on one asset, or even an Airbnb, and you're materially participating in that. And then you aggregate it with these other assets. Okay. So this is, to my understanding, how most of the people I know who are taking losses from syndications and basically generating negative numbers on their 1040. Okay. When I say negative numbers on the 1040, then you are offsetting other earned income, other taxable income. It doesn't have to be W-2 income. People are always saying, can this offset my job income? All that matters is if it's a negative number on your 1040. If it's a negative number on your 1040, it will offset any other income, whether it's from a job, whether it's from, let's say, high yield debt in a taxable account that's taxed as ordinary income. It doesn't really matter where the money comes from. It's offsetting taxable ordinary income. Okay. So this is how most of the people I know who are using apartment syndication investments to offset their taxable income as an LP, they are already meeting the material participation test and real estate professional status because they have other deals that they manage or are meeting those material participation numbers. And so these other passive investments, they're just aggregating together. So they make that election to aggregate. Okay. I should just stop it here. And I will, because I just ran out of time on my memory card. So I'm going to talk about the downsides of this tomorrow. All right. Until tomorrow for episode 137, this is not legal, financial, accounting, or any other advice. Until then, have a great night for up till episode number 137 tomorrow, December 1st already? Yeah. All right. Take care.